Hello everyone, welcome to our discussion of how to prepare the cash flow statement. We introduced the idea of the cash flow statement clear back in Accounting 150, and we've kind of alluded to it a couple of times since, but really not the in-depth as to how to prepare it, like we did the income statement, balance sheet, and statement of equity. So we're kind of filling in a gap that you got in your earlier accounting classes in terms of the cash flow statement. It tends to give students a little bit of trouble, but if you'll follow the steps as I give them, and then there will be a follow-up video with how you might do that in Excel and show the calculations, then you should be able to do most of the cash flow statement preparation. So we're trying to answer the question, where did the money go? Where did cash? So if cash is a critical piece of our business, meaning we need it to operate, it's not very effective at creating returns. So it doesn't stay cash very long typically. It's most valuable when it's used to and converted into other assets. And so that's why it is always changing. It's always some more cash is coming in, it's cash going out. It has the most activity of any of our assets, and it really is key to being able to be successful. And therefore, we have an entire statement literally answering the question, how did we get from this cash balance to this cash at the beginning of the year to this cash balance at the end of the year? So that kind of hints at what we need to get started on our cash flow statement. First of all, you need the cash for the beginning of the year balance sheet and cash from the end of the year balance sheet. So you need two balance sheets, and I like to set them up side by side. One for, if you're doing 2022, January 1st and then December 31st. Now, just remember, January 1st of 2022 is the same as December 31st of 2021. But so the beginning of the year or the end of last year, or however you want to think about it, and then the balance sheet for the end of the current year, the 2022. So first thing we want to do with those two balance sheets side by side is to check the cash. How much did it change? Did it go up or down? Okay. And then we're going to try to explain that. Okay, that is the position of the cash flow statement. We also need a income statement for that same year, 2022. So if we're doing a cash flow for 2022, we need an income statement for 2022 in addition to those two balance sheets. We are going to organize our cash flow statement into three sections: operating cash flow, investing cash flow, and financing cash flow. So our operating cash flows, positive or negative, plus our investing cash flows, positive or negative, plus our financing cash flows, positive or negative, equals the change in cash of those two balance sheets. So we got cash at the beginning, cash at the end. The difference needs to be explained by taking operating cash flows plus investing cash flows plus financing cash flows. Those three together should equal that change. That's when we know, well, we'll say that's when we have a good idea that we've included everything, we got everything correct. All right, that is, so we really know what the answer is when we start the cash flow. We know that it needs to explain the change in cash. So we generally start with cash flow for operations. There's absolutely no rule that says you have to do it in any particular order. But because cash flow from operations is typically the most important measure, we tend to start there. It's also has the most pieces to it. We're going to learn the indirect method. Not the direct method, the indirect method when we do the cash flow from operations. So with that indirect method, we're going to start the cash flow from operations section with net income, right from the income statement that we said we already had. So we're going to take that net income, and then we're going to adjust that net income to get our cash flow from operations. So we're going to adjust for anything that's different between the income statement, net income, and the cash flow from operations. So there are going to be three types of adjustments. And the first one is we're going to add back any non-cash expenses or subtract any non-cash revenues. So we'd add depreciation. That's a non-cash expense. Why? Because depreciation is recorded by taking debit to depreciation expense, credit to accumulated depreciation. Cash is not involved in that process. Amortization is just a word for depreciation for intangible assets. Any type of impairment to our assets that happens because they are getting obsolete or something like that is a non-cash expense. If we get our debt forgiven by a bank, that would be a non-cash revenue. Another example of a non-cash expense is if we pay employees in stock instead of in cash, then that's an expense for payment, but it doesn't involve cash, so that would be a non-cash expense. So those are going to be listed and added back or subtracted depending on whether they're expenses or revenues. So that's our first adjustment. Includes any of those. We would find our depreciation, amortization, impairment, those types of things on the income statement. We look for those non-cash expenses. The next adjustment is we're going to subtract the gains and add the losses. So remember, we learned in earlier accounting classes that separated on the income statement at the bottom typically are gains and losses, because they're calculated differently than revenues and expenses, and they really are not directly related to cash. And so we're going to take them off by basically subtracting the gains or adding the losses. So you're going to do the opposite. A loss would be subtracted on the income statement. We're going to add it here. Okay? And remember, gains and losses are those things that have to do with the selling of our assets other than inventory. And then the last adjustment is really is going to take multiple steps. It's really lots of adjustments. Okay? We're going to line up that beginning of the year and end of year balance sheet like I talked about earlier. And we're going to compare operating assets and liabilities and calculate the difference between what they were at the beginning of the year and what they were at the end of the year. Now, what do we mean by operating assets and liabilities? For the most part, this is current assets, not including cash, because that's what we're explaining. So we wouldn't use cash to explain the change in cash. Okay? Usually it's current assets, but it's not. That's not a perfect definition. But if we have a question about whether an asset is operating or not, then we will assume it is an operating asset if it's a current asset, and an operating liability if it's current liability. Okay? But the true definition of an operating asset liability is one that has an impact, where the change in that asset or liability has an impact on net income. All right? So once we've lined up our two balance sheets and we've calculated the difference between our assets, current assets and current liabilities, or operating assets and operating liabilities, then we apply this process, okay? We either add them to the cash flow from operations or subtract them based on these rules, all right? An increase in an asset is subtracted. decrease in an asset is added, increase in liability is added, decrease in liability is subtracted. You can try to memorize those. You can just keep those on a card, whatever. All you really have to do is remember one of them, and then you can figure out the others. So if you remember the increase in asset is subtracted, then you know that a decrease in asset is added. You know then that an increase in liability is added because the liabilities are opposite of assets. And then once you know that, you know about the decrease in liability. So you can, it's not that hard to memorize that. So your cash flow from operations is you started with net income, added in your non-cash expenses or subtract your non-cash revenue. Most of the time, that's just non-cash expenses, by the way. Add gains, subtract losses. Next section, then your changes in operating assets and liabilities. So it's going to be the longest section of our cash flow, okay? And it's going to have the most items and is most important. So that's going to give you your cash flow from operations. When we listed, if it's a positive number, we get cash flow from. Okay, if it was negative, it would be cash used in operations. So the next section, big section, is investing. So you've got three big sections: operating, investing, and financing. And you, within your operating, you had three small sections. You'd had the non-cash expenses, the gains and losses, and the changes in operating assets and liabilities. Now we move to the second big section, and that's investing. Okay, this has to do with purchases and sales of long-term assets, aka non-operating assets. So if, for the most part, operating assets are current assets, then long-term assets are non-operating assets. So now, after we consider the investing section, we'll have dealt with all assets. All assets either get considered, any change in assets either gets considered in operating or investing. So there's really only two items: cash received from the sale of non-operating assets and cash paid for the purchase of non-operating assets. So if we sold it, how much cash should we receive? Remember, this is a cash flow statement, so we're only worried about how much cash we received. And if we bought them, how much cash should we pay for those assets? So sometimes that is a little more complicated to figure out. We can't just look at the beginning and ending and take the difference like we did with our operating assets. We might have to do a couple extra steps. We'll have to utilize the beginning and ending, because that's like we did. That's why we have the balance sheet side by side. But there, we may have to consider the possibility that some of the assets were not only purchased but also sold. So for instance, if we had a non-operating asset, long-term asset that is not depreciated, like an investment or land, we would have the beginning of the year assets, the ones on January 1st, and we'd have the ending year assets, ones at December 31st, and we would add any new assets purchased. But we also may have assets that got sold, and if that's the case, then we have to subtract the cost of those assets sold. So you would know the beginning of the year assets and the ending of your assets from the balance sheet. What you wouldn't know necessarily is these two, unless we went and investigated or found out or were told one of the two of those. So if I told you this, you could figure out what that is, because you would know this and this. And as long as you know three of them, you can calculate the fourth. Now, if it is a asset that gets depreciated, like buildings or equipment, it's got an additional step. You have the beginning, you have the ending, You add the new assets purchased. You subtract the cost of the assets sold. Okay? And you have the accumulated depreciation. You subtract the accumulated depreciation and add the accumulated depreciation on the assets sold. So now we're talking about having to consider not just the change in the assets, but also the change in the depreciation. So in our formulas is listed here, the circled amount is what would actually get put on the investing section of the cash flow as a negative, right? Because this is cash purchase, so we spent cash on it. Okay. The rest of it is just information we need to calculate what we put on the cash flow. None of the rest of it would go on the cash flow itself. So for the cash received, that's usually pretty easy, straightforward. You usually can go back and see exactly how much cash you received from the sale of assets. But sometimes if there were sale of those assets, the calculating how much was purchased, if we are not told directly, can be a little tricky because you have to use these formulas. Okay? Now, just to review, the sale of a depreciating asset, so that if you have to look back at your journal entry to figure out any of the pieces we needed for the last slide calculation. Remember, if we sell it for cash, we debit cash. And this is the cash from the sale. It goes on the cash flow statement. So that part's the easy one. We reduce the asset by the original cost. What we originally paid for it, we credit that asset. That's a credit to that T account. We reduce the accumulated depreciation on the asset sold. We debit accumulated depreciation for all the depreciation on that asset prior to sale. And then we either credit gain or debit loss to make the debits equal to credits. So when we dealt with long-term assets in Accounting 151, okay, this is how we learned to record the sale of that asset. All of these pieces are incorporated in our formula for the cash, calculating the amount of paid for assets on the cash flow statement in the investing section. So that wraps up. Remember, there's really only two things in the investing section. Cash paid. Now, if you have multiple long-term assets, then you have to do it for each one. But it is really only cash received from the sale and cash paid for new assets, however many assets that is, or how many other types of assets you list there as long-term assets. Final section, financing. This has to do with non-operating or long-term liabilities. Again, we've got their two balance sheets side by side. We're looking at the beginning of the year, the end of the year. The operating liabilities are dealt with in the operating section. Non-operating liabilities are dealt with in the financing section. We are also in the financing section going to deal with any changes in the stockholders' equity section of the balance sheet. Okay, any increase in common stock and additional paid-in capital is added together. Okay, when we sell stock for cash, we credit both common stock and additional paid-in capital. So we're going to take the differences for those two, add them together, and that's going to be the cash received from the sale of stock. Okay, any increase in treasury stock is a negative cash amount for the purchase of treasury stock in the financing section. And then we have our change in retained earnings. Net income minus dividends, right? If you have net income, it makes your retained earnings go up. Dividends makes it go down. You know what the net income is from the income statement. You know that the retained earnings at the beginning of the year, retained earnings at the end of the year. So you know what the change in retained earning is. So if the dividends are not given, you can calculate the dividends by taking the difference between what your net income is and what the change in your retained earnings is. Remember, dividends are always a subtraction for cash in the financing section, always a reduction of cash. Now, you could have a little bit of a challenge with long-term liabilities, long-term loans, where you may be borrowing from one bank and paying another bank or something like that. You may have new loans. You may have payments on those loans. So it can go either direction. So we compare the beginning of the year note payable to the end of the year note payable. Beginning it was $100,000. The end of the year it was $150,000. So our formula is going to be $100,000 plus the amount borrowed minus the amount paid, ends up with $150,000, right? So the easy way would just say it changed by $50,000. But that's not sufficient for long-term loans. We have to tell our readers how much each of the amounts borrowed and each of the amounts paid back was. So we look up the payments and find that they're $20,000. So if we know that this started at $100,000 and we paid $20,000, then we know we must have borrowed $70,000. That's the only way that this could work. Again, if we know three of them, we can figure out the fourth. And then we would list the $20,000 as negative in the financing section and $70,000 as positive. Not just a $50,000, but we have to separate the two. Just as a hint in terms of reading the balance sheet and using it for cash flow, if you see the term current portion of long-term debt, that is the amount that's got to be paid in the next 12 months. So if you see a balance sheet at the end of a year, like end of 2019, and it says $20,000 in current portion of long-term debt, you can count on the fact that that is going to be paid in 2020. And so that would be the payment, okay, amount for 2020, just as was shown up here. And so you would know that even though it didn't say explicitly, we paid $20,000 on the loan. So now we've talked about all the pieces. This is kind of how we pull this all together. Each section of our cash flow has a subtotal. You've got to label that total. Is that subtotal? Subtotal is referred to as cash provided by, if it is positive, or cash used in, if it is negative. Add up the subtotals to get the change in the cash, as we talked about at the beginning. Now, show your reconciliation. Show that you took the beginning and ending cash on the balance sheet and that it equals the same as the change in cash that you just calculated in the cash flow. Just to tie it all together and make sure that it's easy to see. And then there are these extra disclosures at the bottom of your cash flow statement. Significant non-cash investing or financing activities should go at the end. That means that there was a significant change in long-term liabilities, long-term assets, stock, but it didn't involve cash. So example is if we use stock to buy a building, we would see an increase in building. We would see an increase in stock, but there would be nothing on the cash flow in the regular sections about it. That would be somewhat confusing. So we put that at the bottom and say, well, the reason why you see this big change on the balance sheet but nothing reflected in the regular cash flow is because this was a non-cash transaction. And then we must disclose how much cash we paid for interest and how much cash we paid for taxes, particularly two things we're interested in, and how much cash is actually going out the door for those two items. To wrap this up, we need to have some understanding of what the cash flow is telling us. Okay, we know that cash flow from operations is, we want it to be positive. We want it to indicate that we are healthy company providing enough cash that we can pay our bills, that we can invest it in other things, that we can pay off our loans, all that type of stuff. And so we might calculate some ratios on the cash flow statement separate from those that we calculated on the income statement and balance sheet. So we might compare our cash from operating activities, the first section, and divide that by current liabilities from the balance sheet to see how much cash we are generating and such that we can pay our liabilities. Okay, are we making enough cash that we can pay off our bills? Okay, take our cash provided by operating. You see a theme here. Cash provided by operating activities, most important measure in all three ratios, divided by capital expenditures, which is what we paid for plant and equipment. Were we able to generate enough cash from just operating that we could buy new equipment, or did we have to borrow the money? So if we can have as much cash provided by operating activities as we have capital expenditures, then that's a good sign in that we don't have to use other people's money. We can use our own money to buy new assets and grow. And then cash provided by activities minus capital expenditures, minus what we paid for new assets, minus our dividends, is our free cash flow. That's the extra cash flow after we have covered the things that we need, our new equipment, after we've made our shareholders happy with the return on their money. What do we have left in case we want to increase our things for next year?